The man who predicted the 2008 collapse is warning about something bigger. Ray Dalio, the billionaire who built Bridgewater Associates into the world's largest hedge fund, has been saying it plainly for months now. America's debt crisis isn't theoretical anymore. It's arithmetic. And according to his analysis, the consequences could begin unfolding as early as 2026. For those of you over 65, this isn't distant thunder. This is something happening in your timeline, in your counts, in the years you were counting on. Before we go further, understand this. Nothing you hear today is financial advice. I'm not your advisor, and Ray Dalio isn't speaking directly to your situation. What follows is an exploration of his thinking, his warnings, and the principles he's lived by through multiple crises. You'll need to make your own decisions, ideally with professionals who know your specific circumstances. But his perspective, earned through 5 decades of navigating markets, deserves your attention, especially now. Dalio has spent the last several years studying something he calls the long-term debt cycle. It's a pattern that repeats roughly every 75 to 100 years, and according to his research, we're approaching a dangerous inflection point. He's not making predictions based on theory, he's reading history. The same dynamics that preceded the fall of reserve currencies throughout history, from the Dutch guilder to the British pound, are showing up in American data today. Rising debt, declining productivity growth, internal political conflict, external competition for global influence. The pattern is unmistakable to someone who's made it his life's work to study how empires rise and fall. Here's what most people miss. Dalio isn't a doomsayer by nature. He's a pragmatist. His entire philosophy centers on understanding reality and adapting to it. When he talks about debt crises, he's not trying to scare you. He's trying to prepare you. Because, in his view, the retirees who suffer most in these transitions are the ones who refused to look at the numbers until it was too late. The ones who kept saying, "It'll be fine," while their purchasing power quietly eroded. The ones who believed that what worked for the past 40 years would continue working for the next 20. Let's get practical about what he's actually seeing. The United States is carrying over $34 trillion in federal debt. That number is climbing by roughly $2 trillion per year. Interest payments on that debt now exceed what the country spends on defense. Think about that for a moment. We're paying more to service old borrowing than we are to fund the military. And under current projections, those interest costs will only accelerate. Dalio has pointed out repeatedly that this creates a trap. The government must keep borrowing to pay interest on existing debt, which creates more debt, which creates more interest payments. It's a spiral, and spirals don't reverse themselves gently. Now add in the political reality. We have a new administration coming in with ambitious promises. Tax cuts, infrastructure spending, expanded programs. All of it requires money the Treasury doesn't have. Both parties have demonstrated an unwillingness to make the hard choices, cutting spending or raising taxes significantly. So the borrowing continues. And here's where Dalio's warning becomes specific. He believes that sometime in 2026, the bond market could begin to revolt. Not dramatically, not with a sudden crash, but with a slow, steady refusal to keep lending to the U.S. government at affordable rates. When bond yields rise, which means the government must pay higher interest to borrow, everything else in the financial system adjusts. Mortgage rates climb, corporate borrowing gets more expensive, stock valuations compress, and for retirees living on fixed income, the consequences show up in two painful ways. The purchasing power of your savings declines as inflation picks up, and the value of your bond holdings drops as rates rise. You get hit from both sides. Dalio lived through this before. In the late 1970s and early 1980s, he watched bond investors get destroyed by inflation. People who thought they were being conservative, who'd parked their money in safe government bonds, saw their wealth cut in half in real terms. Not because the bonds defaulted, but because inflation ran at 12% while their bonds paid 6%. The math was merciless, and he's seen the same pattern in other countries, other currencies, other eras. When governments borrow too much and refuse to cut spending, they eventually inflate their way out, not because they want to, but because it's the only politically feasible option left. Here's the truth. No one wants to say out loud, inflation is a tax. It's a hidden tax on savers, on retirees, on anyone who can't adjust their income quickly. And it's the tax governments choose when they can't or won't choose the visible taxes. Dalio has been explicit about this. He believes the Federal Reserve and the Treasury will ultimately choose inflation over default, will choose currency devaluation over political collapse. Because that's what countries in this situation always choose. It lets politicians avoid making cuts. It lets them keep promises to voters even when the math doesn't work. And it quietly transfers wealth from creditors to debtors, from savers to borrowers, from retirees to the government. If you're 65 or older, you don't have time to recover from a lost decade. That's the brutal arithmetic of retirement. A 30-year-old who loses half their portfolio in a crash has 3 decades to rebuild. You don't. Your timeline is compressed. Your margin for error is gone. And that's why Dalio's warning matters so much more for your generation than for younger investors. You're not positioned for volatility. You're positioned for stability. And stability is exactly what debt crises destroy. Let's pause here and understand Ray Dalio's journey, because his credibility on this topic wasn't handed to him. It was earned through failure. In 1982, he made a spectacularly wrong prediction. He was convinced the economy was about to collapse into depression. He went on television, wrote newsletters, positioned his fund entirely for disaster. And he was completely wrong. The economy recovered. The stock market soared. His fund nearly went bankrupt. He had to let go of employees. He had to borrow money from his father to pay bills. At 42 years old, he was essentially starting over. Most people would have quit. Most people would have blamed the system, blamed the data, blamed bad luck. Dalio did something different. He became obsessive about understanding why he'd been wrong. He went back through history, studying every major debt crisis of the past century, the Weimar hyperinflation, the Great Depression, the Latin American debt crisis of the 1980s, the Japanese asset bubble. He wasn't looking for stories. He was looking for patterns, for mechanics, for the repeating sequences that show up when debt gets out of control. And what he discovered changed everything. He realized that debt crises follow a template. They don't happen randomly. They happen when debt burdens reach a certain threshold relative to income, when interest costs consume too large a share of revenue, when the only way to keep the system functioning is to create more money. He built quantitative models to track these variables across countries and centuries, and the models worked. They helped him navigate the 2000 dot-com crash. They helped him see the 2008 financial crisis coming when almost everyone else was blind to it. In 2007, while most of Wall Street was celebrating record bonuses, Dalio was quietly positioning Bridgewater for collapse. When Lehman Brothers fell and the global financial system seized up, his fund made 14%, not because he got lucky, but because he understood the pattern. Now, 17 years later, he's seeing the same pattern again. But this time, it's bigger. This time, it's not subprime mortgages or over-leveraged banks. It's sovereign debt. It's the reserve currency itself. And that, he says, changes everything. Because when individual companies fail, the system absorbs it. When banks fail, governments bail them out. But when the government itself becomes the problem, when the lender of last resort is the one running out of credibility, there's no one left to call. The only option is monetary inflation, currency devaluation, and a slow erosion of purchasing power that most people won't even recognize as a crisis until years after it's begun. So what does Ray Dalio actually do with his own money? Because that's the question that matters most. Theory is cheap. Action reveals belief. And Dalio's positioning tells you everything you need to know about how seriously he takes this warning. He holds gold. Roughly 15% of Bridgewater's all-weather portfolio is allocated to gold and other precious metals, not as a speculation, not to get rich, as insurance against exactly the scenario he's been warning about. Because gold is the one asset that maintains its purchasing power when currencies lose theirs. It's been true for 3,000 years, across every civilization, every empire, every monetary system. When governments print, gold holds. He also diversifies across geographies. Bridgewater holds assets in multiple currencies, multiple countries, multiple systems. Because Dalio learned long ago that concentration is the enemy of survival. It doesn't matter how confident you are in one country, one currency, one system. Empires fall. Reserve currencies change. The British pound was the world's reserve currency for a century until it wasn't. The Spanish real before that. The Dutch guilder before that. Dalio studies these transitions, and he structures his portfolio to survive them, not to profit from them necessarily, just to survive. And here's something most people don't know. Despite building one of the most sophisticated investment firms in history, despite having access to the best quantitative models and the smartest analysts, Dalio's personal investment philosophy is almost shockingly simple. He believes in balance. He built something called the all-weather portfolio specifically for people who don't want to make predictions, who don't trust their ability to time markets, who just want to survive and compound over decades. The allocation is static: stocks, bonds, commodities, gold, inflation-protected securities, rebalanced mechanically. No forecasting required. It's designed to perform reasonably well in any economic environment. Growth, recession, inflation, deflation. Consider this carefully. The man who predicted multiple financial crises doesn't trust his ability to consistently predict the future. Think about what that means. He spent 5 decades studying markets, has built quantitative systems that most universities couldn't replicate, has access to information and analysis beyond what 99% of investors will ever see. And his conclusion is that humility matters more than brilliance. That balance matters more than conviction. That surviving matters more than winning. There's a deeper pattern here that retirees especially need to understand. When you're young, Asymmetric bets make sense. You can afford to be concentrated, to be aggressive, to swing for the fences. Because if you're wrong, you have time to recover. But after 65, the math changes completely. Now you need what Dalio calls asymmetric defense. You need to protect against catastrophic loss more than you need to chase spectacular gains. Because spectacular gains don't change your life at 70, but catastrophic losses end it. This is where most retirement advice gets it exactly backwards. The conventional wisdom says to shift into bonds as you age, to be conservative. But Dalio's warning is that traditional conservative portfolios, heavy in government bonds and cash, are precisely the portfolios most vulnerable to the crisis he's describing, because inflation and rising interest rates destroy bonds. They destroy cash. They destroy everything that's denominated in dollars and paying a fixed return. The safe assets become the dangerous ones when the currency itself is in question. Here's the truth no one talks about. You can't avoid risk at 65. You can only choose which risk you're willing to take. The risk of stocks volatility, or the risk of inflation erosion, the risk of market crashes, or the risk of currency devaluation. There is no risk-free option, no matter what the advertisements promise. And Dalio's entire framework is built around accepting this reality and structuring your portfolio to survive whichever risk actually shows up. You don't know if 2026 will bring inflation or deflation, growth or recession, currency crisis, or continued stability. So you hold assets that do well in each scenario. You balance the risks instead of trying to predict which one will hit. Let me show you something about how Dalio thinks about timelines. Most investors focus on the next quarter, the next year, maybe the next presidential cycle. Dalio thinks in debt cycles that span 75 years. He thinks in currency regime changes that happen once a century. He's not trying to predict whether the market goes up or down next month. He's trying to position for structural changes that unfold over decades. And when you're 65 or 70, that's actually your timeline too. You might need your money to last another 30 years. You might need to fund 2 or 3 decades of retirement. That's not short-term. That's actually a long-term investment horizon, even if it doesn't feel that way. So when Dalio warns about 2026, he's not saying that's when everything collapses. He's saying that's when the pressure might become visible. That's when bond yields might start rising in ways that force uncomfortable choices. That's when the slow grind might begin. And slow grinds are actually more dangerous than sudden crashes for retirees because slow grinds don't trigger your defense mechanisms. They don't make headlines. They just quietly erode your purchasing power year after year until you wake up at 75 and realize your income buys half of what it did at 65. Dalio tells a story about his father. His dad was a jazz musician who never made much money, never had a sophisticated investment strategy, never even really understood the markets. But he had one principle that he followed religiously: never go into debt. Not for cars, not for vacations, not for anything except the house. And when Ray's father retired, he lived comfortably on very little, because he had no debt servicing costs eating into his income. Ray credits that lesson, that simple, unglamorous discipline, as one of the most valuable things he ever learned about money, because debt magnifies disaster. When things go wrong, when income drops or costs rise or markets fall, debt turns problems into catastrophes. And the people who suffer most in every crisis Dalio has studied are the ones carrying debt when the music stops. If you're retired and carrying any significant debt right now, this is the warning that should keep you up at night. Not the stock market, not inflation alone. The combination of inflation, rising rates, and debt. Because that combination is toxic. Your costs go up, your income doesn't, and your debt payments consume more and more of what you have left. Dalio has watched this pattern destroy retirees in country after country, crisis after crisis. The ones who make it through are the ones who entered the crisis with no debt, with diversified assets, with realistic expectations about returns. Now, watch what happens when you combine Dalio's warnings with basic retirement arithmetic. Let's say you have $500,000 saved. You're 70 years old. You're withdrawing 4% per year to live on, which is $20,000. That's a conservative withdrawal rate by historical standards. But now, imagine inflation runs at 6% per year for the next 5 years, while your portfolio only returns 3%. You're losing 3% of purchasing power every year. After 5 years, your $20,000 withdrawal only buys what $13,000 used to buy. You haven't run out of money, but you've run out of lifestyle. You've run out of choices. You've become dependent on family or government assistance, not because you were reckless, but because you trusted that the past would continue. This is what Dalio means when he talks about the risk you don't see. Most retirees are preparing for market crashes because market crashes are visible and dramatic. They make headlines. They trigger fear. But currency devaluation happens slowly, quietly, in ways that most people don't recognize until it's done. And it's far more dangerous to retirees than a market crash because markets recover. Currencies that lose reserve status don't. The British pound never reclaimed its dominance after World War II. The Spanish real never recovered after Spain's empire collapsed. These transitions are one-way doors. Dalio isn't predicting America's collapse. That's not his message, and it's not his belief. What he's saying is that America's role in the global financial system is changing, that the dollar's dominance can't be taken for granted, that the privileges that come with being the reserve currency, the ability to borrow cheaply, to run deficits indefinitely, to export inflation to other countries, those privileges are eroding. And when they erode, Americans will feel it in their purchasing power, in their investment returns, in their standard of living, especially Americans who are no longer earning, who are living off accumulated savings. There's a conversation Dalio had with another legendary investor, Paul Tudor Jones, that illustrates this perfectly. Jones asked him what keeps him up at night, and Dalio's answer wasn't market crashes or geopolitical conflict. It was something simpler, the possibility that he might be wrong about what's prudent, that the caution he's advocating might turn out to be unnecessary, that he might cost people gains by encouraging too much defense, because that's the paradox of good risk management. If you're properly positioned for disaster and disaster doesn't come, you underperform. You look like you worried for nothing, and there's social pressure, internal pressure to not be that guy who cried wolf. But then Dalio said something that should be carved into stone in every retirement planning office. The worst losses happen when people are convinced they can't lose. That's when portfolios get concentrated. That's when leverage gets added. That's when risk gets invisible. And for retirees especially, the cost of being wrong about safety is permanent. You don't get a do-over at 75. You don't get to go back to work for 10 years and rebuild. The margin for error isn't small. It's zero. So what does practical wisdom look like in this environment? Not advice, because I can't give you that, but principles that Dalio has articulated and lived by. First, own what you understand and can sleep with. If gold makes you anxious, if you don't understand why anyone would own metal that pays no interest, then don't force it into your portfolio just because Dalio does. But understand the purpose. Understand that it's insurance against scenarios where paper currency loses purchasing power. You don't have to love insurance to recognize its value. Second, avoid the extremes. Don't go all in on cash because you're scared of stocks. Don't go all in on stocks because you're scared of inflation. Don't go all in on gold because you're scared of currency collapse. The whole point of Dalio's framework is that you don't have to predict which scenario unfolds. You just have to make sure you survive whichever one does. And survival means balance. It means holding assets that behave differently in different environments. It means accepting that part of your portfolio will always be underperforming and being okay with that, because the part that's underperforming today might be the part that saves you tomorrow. Third, stress test your plan against the scenarios Dalio is warning about. Sit down with someone who knows numbers and run the math. What happens to your retirement if inflation averages 5% for the next decade? What happens if bond values drop by 30%? What happens if the stock market goes nowhere for 5 years while your costs keep rising? These aren't abstract questions. They're the questions that determine whether you maintain independence or lose it. And most retirees never ask them because asking feels like inviting trouble. But not asking doesn't make the trouble go away. It just makes you unprepared when it arrives. Fourth, simplify everything else in your life so you have buffer for financial complexity. Dalio has talked about this in interviews. He said that as he got older, he became almost obsessive about reducing stress in every area except the areas that truly matter. He structures his days the same way. He meditates every morning. He exercises. He limits commitments. Not because he's lazy, but because he's learned that decision-making quality deteriorates when you're overwhelmed. And at 75, decision-making quality is everything. You can't afford to make important financial choices when you're stressed, exhausted, or distracted by 100 other things. Fifth, stay humble about what you know. Dalio built a multi-billion-dollar fortune, and he's still constantly saying, "I might be wrong." That's not false modesty. That's wisdom earned through failure. He knows that the most dangerous investors are the ones who are certain, who have it all figured out, who mock caution as weakness. Those investors get destroyed eventually because reality doesn't care about confidence. It only cares about accuracy. And accuracy requires admitting what you don't know, which frees you to prepare for multiple possibilities instead of betting everything on one outcome. Let's come back to where we started, a debt crisis in 2026. What does that actually mean for your daily life? It probably doesn't mean dramatic headlines to market crashes, at least not right away. It probably means interest rates that stay higher than you expected. It probably means inflation that persists instead of falling back to 2%. It probably means your purchasing power gets quietly squeezed year after year. It probably means the investment returns you were counting on don't materialize, not because markets collapse, but because they just don't grow the way they did for the past 40 years. And here's what that means practically. You might need to adjust your spending. You might need to accept a slightly smaller lifestyle than you'd hoped for. You might need to have uncomfortable conversations with family about inheritance or support. These aren't catastrophes. They're adjustments. But they're adjustments that become much harder if you wait until you're forced to make them versus making them proactively while you still have options. Dalio has said repeatedly that the biggest mistake most people make isn't being wrong about markets. It's being inflexible in response to reality. It's holding on to a plan that's no longer working because you're too proud or too scared to change it. And retirees are particularly vulnerable to this mistake because you've often spent decades building a specific vision of what retirement should look like. You've earned that vision. You've sacrificed for it. And admitting that external circumstances might require adjusting it feels like failure. But it's not failure. It's adaptation. And adaptation is what separates people who maintain dignity through crises from people who lose everything. There's a longer arc to consider here, something that goes beyond 2026 or this particular debt cycle. Dalio has written extensively about how societies handle aging populations with insufficient savings. And the reality is brutal. They inflate the currency. They reduce the real value of promised benefits. They find ways to transfer wealth from older generations to younger ones because younger generations vote and work and pay taxes. This isn't a conspiracy. It's just the political arithmetic of democracy when the numbers don't work. And if you're 65 or older, you're on the wrong side of that arithmetic. Not because you did anything wrong, but because you're in the generation holding fixed claims on a currency that needs to devalue. That's dark. I know it's dark. But Dalio would say that seeing reality clearly, even when it's uncomfortable, is the first requirement of surviving it. You can't protect against threats you refuse to acknowledge. And the threat here isn't that America fails or collapses or descends into chaos. The threat is much more mundane, that the value of $1 in 2030 might buy 70 cents worth of goods from 2025. That the retirement you planned based on past inflation rates might not work at future inflation rates. That the assumptions built into every retirement calculator and financial plan might turn out to be optimistic. So you plan for that, not by panicking, not by making radical changes, but by building in cushion, by spending a little less than you could, by maintaining flexibility in your big costs, by not committing every dollar to fixed expenses that can't be adjusted if circumstances change, by staying engaged with your finances instead of setting things on autopilot and hoping. These aren't heroic actions. They're not exciting or impressive. They're just the quiet disciplines that let you maintain control when other people are losing it. There's a phrase Dalio uses that captures all of this. Don't let the perfect be the enemy of the good. You're not trying to optimize your retirement for maximum gains. You're not trying to predict the future perfectly. You're not trying to time the market or outsmart professional investors. You're just trying to avoid catastrophic mistakes while capturing enough return to maintain your lifestyle. That's it. That's the whole game after 65. And it's a game you can win by being prudent, diversified, realistic, and humble. He tells another story, this one about his decision to step back from day-to-day management of Bridgewater. He was in his 60s. The firm was wildly successful. He could have kept running it for years. But he chose to transition leadership to younger people while he was still sharp, still capable, still in control of the timing. Because he understood that holding on too long is one of the most common mistakes successful people make. They wait until they're forced out by age or decline or circumstance, and by then they've often made decisions that damage what they built. Better to step back while you still have clarity, while you can still execute the transition on your terms. That same principle applies to retirement finances. Better to simplify your portfolio while you're still mentally sharp. Better to reduce your spending while it's a choice rather than a necessity. Better to have the hard conversations with family about money and legacy and support while you can still lead those conversations with authority. Because the alternative is waiting until you're diminished, until decisions are being made for you rather than by you. And there's a dignity in maintaining agency, in staying ahead of circumstances rather than being dragged by them. Ray Dalio is 80 years old as I record this. He's worth billions. He could spend his time on yachts or golf courses or enjoying the fruits of 5 decades of success. Instead, he spends his time writing books, giving interviews, warning people about risks he sees coming. Why? Not because he needs the attention or the money, because he's studied enough history to know that big transitions are painful, and the pain is worst for people who aren't prepared. He's trying to prepare people, not with hype or fear, but with sober analysis of patterns that have repeated throughout human history. You can dismiss his warnings. You can decide he's being too cautious, too pessimistic, too focused on tail risks that probably won't hit. That's your choice, and it might even be the right choice. Markets might keep climbing. Inflation might stay subdued. The debt might prove manageable. America might maintain its reserve currency status for another 50 years. All of that is possible. But if you're 65 or older and you're dismissing these warnings without stress testing your plan against them, you're not being optimistic. You're being reckless, because optimism without preparation isn't a strategy. It's just hope. And hope isn't enough when the margin for error is gone. The sun is setting on the era you built your retirement assumptions around. Maybe slowly, maybe gently, maybe with enough time to adjust. But it's setting. The world your grandchildren will retire into won't look like the world you retired into. The dollar might not be the reserve currency. The government might not be able to afford the promises it made. The investment returns might be lower. The inflation might be higher. These aren't predictions. They're possibilities that have precedent, that have happened before in other countries and other eras. And Ray Dalio, who has studied those precedents more carefully than almost anyone alive, is saying, prepare, not panic. Prepare. There's a peace in that, a strange peace in accepting that you can't control the macro forces, can't stop debt cycles or currency transitions or political dysfunction, but you can control your response. You can control your spending. You can control your asset allocation. You can control your expectations. You can control whether you stay engaged or check out. And that control, that agency, that's what separates people who maintain dignity through difficult times from people who become victims of them. Dalio meditates every day. He's practiced transcendental meditation for over 40 years. And he said in interviews that it's not about achieving some mystical state. It's about maintaining equilibrium. It's about not getting swept up in the emotions of markets or the panic of headlines. It's about staying centered when everyone around you is losing their center. And that's the final lesson here, maybe the most important one. The next few years might be turbulent. They might test your plan and your nerve and your patience, but if you've prepared, if you've thought through the scenarios, if you've built in cushion and diversification and humility, then you can weather it. Not because you're brilliant or lucky, but because you were prudent when prudence wasn't exciting. You've lived long enough to know that most noise is just noise, that most predictions are wrong, that most fear is misplaced, but you've also lived long enough to know that occasionally the warnings are real, that occasionally the patterns do repeat, that occasionally the people who paid attention and prepared came out okay, while the people who ignored it and hoped suffered. This might be one of those times, or it might not. But either way, the cost of preparation is small, and the cost of being wrong without preparation is catastrophic. So take the warning seriously without letting it consume you. Adjust your plan without abandoning it. Build in safety without becoming paralyzed. Stay engaged without becoming obsessed. And above all, maintain the peace that comes from knowing you've done what you can with what you control. The rest is just weather. You've weathered storms before. You'll weather this one too. But you'll weather it better if you see it coming. Ray Dalio isn't offering you certainty. He's offering you a framework for surviving uncertainty. That's all anyone can offer, really. The future is always uncertain. The variables are always beyond control. But some people navigate uncertainty better than others, and the ones who do share certain habits. They stay informed, they remain flexible, they balance their risks, they control their emotions, they prepare for multiple possibilities instead of betting everything on one outcome. That's not genius. That's just wisdom. And wisdom is exactly what retirement requires. The debt crisis might come in 2026. It might come later. It might not come at all, at least not in the form Dalio expects. But the principles he's advocating, diversification, humility, balance, realism, preparation, those principles are valuable regardless of what actually happens. They're the principles that let you sleep at night. They're the principles that let you enjoy your retirement instead of spending it worried about money. They're the principles that let you maintain independence and dignity even if circumstances turn difficult. You didn't work 40 years to spend your retirement anxious. You didn't save and sacrifice and build a nest egg just to watch it erode through mistakes that were avoidable. You deserve peace. You deserve security. You deserve to enjoy these years without constant financial stress. And the path to that peace isn't pretending risks don't exist. It's preparing for them so thoroughly that when they arrive, they're manageable instead of catastrophic. Ray Dalio has made his career on being prepared, on seeing patterns others miss, on staying calm when others panic, and on surviving transitions that destroyed less careful investors. He's not asking you to copy his portfolio or follow his specific moves. He's asking you to adopt his mindset, to look at reality clearly, to stress test your assumptions, to build in margin for error, to stay humble about what you know and what you don't, and to make the adjustments now while you still can, rather than waiting until you're forced to. That's the message, not fear, not hype, just honest, hard-won wisdom from someone who's seen this pattern before. Take it or leave it, but take it seriously, because the stakes at your age couldn't be higher. This is the money that has to last. This is the plan that has to work. There are no do-overs, no second chances, no opportunities to go back and fix it if you're wrong. This is it. So get it right. not perfect, but right. And trust that prudence, even if it feels boring or excessive or unnecessary, is exactly what these times require. The sun sets, the light changes. But those who prepared before dark, who brought what they needed, who knew the path and checked their provisions, they make it home. Not because they were smarter or luckier, because they saw the horizon clearly and acted while there was still time. Be one of them.